Hey, this is Skyler with Regan. We had a huge move in rates last week. As you can see here, almost the entire curve was up 20 basis points, which led to pretty big losses on the back end. If we look at that table and we look at that move, 20 to 25 basis points on the long end of the curve here. And a reminder, this 10-year here is about a 7-year duration. The 30-year is about a 17-year duration. So 17 times roughly 20 basis points. We're talking about a 3.5 point loss or so on the long end. So what happened in bonds last week? Bonds were down roughly 115 basis points. Stocks were basically flat. Now we had a big sell-off here on Friday, but up until that point, stocks had a really great week. And from week beginning, weekend, or Friday over Friday, stocks were actually up about 20 basis points. Now, why is that? Well, first of all, correlations have been out of whack. We were sitting with negative bond stock correlations for a very, very long time as inflation was low post GFC 0708, all the way through basically 2021 when the Fed started hiking interest rates, which they started doing in early 2022. So let's dig into interest rate movements and their effect on the consumer and on corporations. And first of all, we're going to look at Fed's fund rates here. Let's look at the upper bound over the last 7 years or so, because we've had significant movements, obviously, since 2020. We'll go back 5 years, 6 years, where we had about 500 basis points of movement here between March of 2022 and July of 2023, 525 basis points over 11 cuts, or I'm sorry, 11 hikes in a row. Okay. So, well, rates have gone crazy. You know, the 10 years up over 450 today, the 30 years at 512, the 2 years over 4%, all these magical numbers that have historically signaled buy the dip when it comes to bonds. And well, if you do buy today, and let's say from here until the rest of the year, and interest rates were to go up. So I peg in here 4.25. That's a 20 basis point move on the 2 year higher, 5%, that magical 5% on the 10 year, and 550 on the 30 year. What does that do to your investments? What does that do to your bond investments particularly? And that signifies a move from here up to here. Well, you're still going to make money. Okay, because you have this higher starting point yield. The 2 year here is about 505. Say it goes up 20 basis points times a 2 year duration. That's a 40 basis point loss roughly. Well, you're still going to make 2.2%. Okay. And you're going to make money all the way out until you get to about the 8 year part of the curve. Okay. You can see the 7 year makes money, the 10 year and the 30 year lose money in this scenario. Well, what if it gets a lot worse? What if, let's say, the 2 year gets to 450 and the 10 year gets to 550 and the 30 year gets to 6? Okay, what happens to investors? Okay, well, you're going to still make money all the way out until the 5 year. Okay, and even crazier, let's look at 5% on the 2 year, 6% on the 10 year, and 7% on the 30 year. Okay. The market is saying this would be absolute mayhem and the market's going to break. Well, for fixed income investors, not so much. You're still going to make money staying on that 2 year part of the curve, even if interest rates go up 95 basis points from 4.05 up to 5, because we have much higher starting yields today than we did 5 years ago. Okay, this is eerily reminiscent to 1994 when rates went up tremendously. Greenspan rose rates unexpectedly, and the bond market was down roughly 3% that year because you had much higher starting yields. That's where we stand today. So sticking to this 2 to 3 year part of the curve is really the sweet spot, given that the back end of the curve may be a little bit unhinged today. So why is that, and why aren't these things transmitting to the economy and to borrowers in the stock market? And so two last charts here that I think are super important that the market's ignoring, which is debt to assets, i.e. leverage that consumers and corporations are taking on. So here we have consumer debt as a percentage of total assets. And we're staring down the lowest percentage on this data's history, which is only 25 years or so, 35 years from 1990 to today. Okay. So at only 10%, and it peaked at roughly 20%, leverage is at all time lows. Let's look at corporate data. This goes back to 1952. Corporate debt relative to the market value of US corporations, and these are public companies, is also at its lowest level on record, 16%. Whereas this peaked at a crazy 130% almost in the 1970s. So we're looking at very little borrowing by both consumers and corporations. So thus, higher or lower interest rates aren't really transmitting into the economy and into the stock market. So you have this really crazy stock market up hundreds of percents, bonds actually down. Bonds have something like a 70 plus month trough from where we were in 2020 to where we are today. Bonds still haven't recovered. So rates can go higher. And at this point in time, that's not really going to affect bond investors if you're staying in that 2 to 3 year part of the curve, which is pretty dang steep right now relative to cash. But buyer beware going out the curve if rates, let's say, go to 550 and let's say 650 on the long end. You can still go out to that 3 year part of the curve or so, and you're going to have a much more interesting investing environment waiting it out this year and staying in that 2 to 3 year part of the curve than you are trying to be a hero taking duration. Thanks.